Hi everyone, welcome to the Rise Up Holding podcast. This is Dhwani Kamdar and I have my friend here with me today. He's the founder of Amity Mortgages and today we're going to be talking about mortgages, of course. So can you tell us a little bit about yourself?
Idwani, thank you for having me.
Of
I'm
course.
Haider Qureshi,
Yes.
and as you mentioned, I've started this company, Amity Mortgages. To give you a little bit of my background, so I've been in the banking industry for about 22, 23 years.
Okay.
I've worked in UAE most of my professional career, about 17 years in UAE with multiple banks, including First Gulf Bank, United Arab Bank, Al Khaliji Bank. In Canada, I worked for a federal government bank, which is
Okay.
called Business Development Bank of Canada.
Okay.
So I've moved back here in UAE. UAE is close to my heart, and
Yeah.
given my past experience in the finance, I thought of just starting this venture to help people with mortgages.
Yes, that's amazing. So, I have a lot of questions for you today, and I think I would start by asking the most important one, uh, which is also the most frequently asked. As an international investor in real estate of UAE, am I eligible to opt for mortgages?
That's a very relevant question in these times. I mean, we see a lot of foreign investors coming
Yeah,
to
like
UAE.
most of the investors in UAE are the non-citizens of UAE.
Exactly. Yeah.
So, this is one of the most frequently asked questions by my clients to me. So,
Right.
what can you guide us through?
Yeah, definitely they are eligible. So not only people living inside UAE, but foreign investors can get a mortgage.
Okay.
The product is a little different. So there are two main differences. One is the loan to value
Okay.
is slightly lower than in case of a resident of UAE. For example, a resident or a UAE national
Yeah.
can get up to 80 or 90% loan to value,
Okay. That's a lot.
which is great.
Which is great. Yeah.
Yeah. So you don't have to put so much
Yeah. So much of a down payment.
down
Your money
payment.
is not
Exactly,
stuck.
exactly.
Okay.
For a foreign investor, it's a bit different. So like I said, it can go up to 50 or 60%
Right.
in case of a foreign investor, which is still not bad. You have to just arrange 40 or 50% and own the property here
Okay.
with the bank finance.
Okay.
The second difference is the interest rate. So interest rate in case of a UAE resident or a UAE national is considerably lower than what it is for a foreign investor.
Okay. So, I had recently read in the newspapers and, it was everywhere that they are planning to reduce the interest rates. Is that true? Like, is it also for the international investors or is it just for the residents?
So it's the high interest rates are currently is a global phenomena.
Okay.
In most of the countries that I've seen, interest rates are at their peak
They're peaking,
in
yes.
quite some time.
Yeah.
So they drastically started increasing the interest rates in the beginning of 2022, if you remember. And in a matter of like 1 year, the increase was quite significant.
Yes, it was.
So in
It
terms
had
of
definitely gone down a lot during COVID.
yeah.
COVID was the time when, they had actually reduced, a lot, but then I think they peaked again right after.
Yeah.
Yeah.
So UAE dirham is, as you know, is pegged to the US dollars.
Yes, I'm aware.
So basically, the interest rate is kind of similar to how the
Okay,
Fed
so as
interest
in
rate
when the
moves.
interest rates in UAE rise, it will also affect the interest rates. I mean, sorry,
It's the other way around.
the other way around, right?
Yeah. So when
So as
Fed
in when
increases,
does our interest rate also affect their interest rate, or is it just the other way?
no. So the dirham has been pegged to USD
To
since like
USD.
1997.
Okay.
Uh, and from that time, the interest rates are kind of linked to the Fed interest rates in
Okay.
US.
Okay.
So our interest rate wouldn't impact
Impact
them.
them.
In fact,
But theirs would
theirs will.
impact us.
Yeah,
Okay.
exactly,
Okay.
exactly.
Understood.
So right now, for the past 5-6 months, the interest rates have kind of plateaued.
Okay.
And I mean, the forecast is, and I wouldn't know, if I knew, I would be a millionaire. So, I mean, the direction looks like that it's going to go down.
Okay.
Yeah, from
That's
here.
great.
Yeah.
So, another question is, how do you compare a mortgage to a payment plan that is provided by the developer? Because what you see these days is that the developers have come up with really interesting payment plans. You also have post handover payment plans. You have 1% payment plan. You have like a 6-year post handover 1% payment plan. So how do you compare this to a mortgage?
Yeah, I mean, that's a good question. I mean, payment plans, if you want to compare it with the mortgage, it's basically the post handover payment plan, because mortgage generally comes into play after the property is completed. So post handover plan, as you mentioned, it can range from 3 to 6 years. Is it maximum 6 years or 4 years? I'm not too sure.
It's also 6, sometimes it's 4. It
Okay.
depends on the
Okay.
developer. Maybe tomorrow somebody will come up with a 10-year post handover payment.
Yeah.
You
Yeah.
never know,
Yeah.
it's the comfort of the
Yeah,
developer.
but let's say today it's between 3 and 6 years.
Yeah.
Right. Now, comparing it with the mortgage, the mortgage can go up to 25 years
Right.
in UAE. So, in terms of amortization, there is a big difference. Obviously, your yearly payments or your monthly payments would be much higher in case of a post handover plan from a developer, while in case of a bank, it will be much lower because the amortization or term of the loan is much longer.
Right.
You're paying that amount over a longer period rather than a shorter period of 3 to 6 years. So that kind of helps with the cash flow
Right.
of the buyer.
Of course, yes, of course. It just makes things a lot more easier.
Yeah, yeah.
Yeah.
And then there is a question of, obviously, the mortgage comes with the interest rate, while the developer finance or the post handover payment plan does not have an interest, right?
Yeah.
But here's the thing, if you go to any developer who's giving you a post handover plan today, I'm pretty sure most of those developers, if you pay them outright upon completion, they will give you a significant discount.
Yeah.
So the cost of interest is already kind of embedded in that post handover plan that is given by the developer.
Right, exactly.
So basically, you replace that cost with the interest rate in case
Yeah.
of a bank finance.
Yeah, understood. So Heather, can you tell us a little bit more about pre-approvals?
Yeah, sure. I mean, pre-approval is essentially an in principle kind of green light from a bank,
Okay.
whether they can look at that financing. It's not an approval, it's not a final approval in any way,
Okay.
but it kind of gives an idea that based on
Whether
the
or not.
information
Yeah,
you've
yeah.
provided, your
Okay.
income levels and other information, whether you will qualify for a final mortgage or not.
Understood. But why is it not guaranteed? I mean, if they go through all the paperwork, so it's still not a final yes from their end.
Yeah. So the difference is that one, in case of a pre-approval, usually you take the pre-approval when you're looking for a property.
Yeah.
So one, you haven't finalized the property, and secondly, bank will not go into the valuation of the property at that stage, obviously.
Yeah, true. So it is also to give the buyer a fair idea about how much will he have to spend out of his pocket.
Basically, decide on their budget.
Understood, yeah. So what is the timeline to get a pre-approval, and what is the timeline to process the mortgage as well?
So timeline is about a week for pre-approval, I would say, and for the mortgage, it varies between 30 to 45 days
Okay,
because there is valuation involved,
okay.
and that can take some time.
And what is bank valuation?
So bank valuation is an estimate of the value of the property, of the market value of that property that the bank is financing. So
Is it similar to the valuation that we do also for rentals to figure out?
yeah, it's kind of the same thing.
Yeah.
But it's more focused towards the market value
Value.
of the property, that in today's date, how much this property can sell for, in the view of a approved valuator of the bank.
Okay.
So it may not necessarily be the same as the purchase price. So you may have bought a property for 2 million, but a valuator could think that it's 2.2 million or even 1.8 million.
So the price of the property could go up?
No, the price of the property won't go up. The purchase price is what
Remains
it
the
is,
same.
remains the same. But from the financing point of view, the bank will finance, like we earlier discussed, that bank will go 80 to 90% in case of a UAE resident, for example. So they will go for 80 to 90% of the value of the property and not the purchase price.
Okay.
So if the valuation comes in less than the purchase price, then the mortgage amount will also be lower, which
Okay.
means
It gets
you
reduced.
have to cover the difference basically.
Understood. All right.
To give you an example, for example, if a property is 2 million,
Yeah.
the purchase price is 2 million dirhams, and it's valued by the bank's valuator at 1.8, then you will get 80%, for example, of the 1.8 million and not 2 million. So the difference between 1.8 and 2 million, which is 200,000, will come out of your pocket.
Can that not create a conflict between the deal?
It can definitely, and normally it's recommended that you put a financing condition in the sale purchase
Yeah,
agreement.
because the whole transaction can get disturbed because of
Absolutely,
this, right?
absolutely. So it's always advisable, put a financing condition there.
What is a financing condition?
So financing condition is if your mortgage gets rejected, the buyer does not pay any penalty. So
All right. So this goes into the contract.
yes,
Okay.
it goes with the contract, and with the contract, generally buyer puts a deposit, right? They give a
Right.
check
Yes.
for, let's say, 10%. So that 10% is at stake if the mortgage does not go through, right?
Right.
So if a mortgage condition is not a mortgage, the financing condition is in place, and the mortgage gets rejected or declined by a bank, they can provide the proof to the other party and not pay that penalty.
Understood. Provided there's a proof from the bank stating that their mortgage has been declined.
Yeah, exactly. Yeah.
Understood. Okay.
Yeah.
So, with regards to what we were discussing earlier, so say if the bank valuation comes lower compared to the
Purchase price.
purchase price, yes.
Yeah.
So, how do we tackle that situation?
So, in order to reduce that risk, that if valuation comes in lower and you have to, you basically get a finance on a much lower amount than you were expecting, which
Right.
means you have to put in additional down payment. Now that can be challenging for many people. Let's say, like we were discussing about that example of a 2 million property, purchase price property,
And the
comes in
valuation comes to like 1.8.
1.8 million, so 200,000 additional has to be put in.
From
So in
my
that,
pocket, yeah.
Yeah, exactly. So to reduce that risk, you can put a valuation clause into the contract of purchase, which says that, for example, 5 or 10% of valuation, if more than 5 or 10% is higher or lower in terms of the valuation of the property, the deal has to be renegotiated. So there is no risk if the variation is more than 5 or 10%.
5 or 10%.
Depending on your negotiation.
Yeah.
So if it's higher, it's in the favor of the seller.
The seller.
And if it's lower, it's in the favor of, obviously, the buyer.
Yeah. Thank you so much, Heather, for answering all of my questions today. And we are looking forward to having some more questions from you guys as well. If you have any questions related to mortgages or real estate, we would love to answer them. And we'll get back again soon and discuss more about what's next to come into the Dubai real estate and the mortgage market.
Absolutely. Pleasure is all mine, and look forward to.
Thank you so
chatting.
much. Thank you.